This presentation is to cover Massachusetts tax returns for tax year 2021. Okay, well, let's look at what's new for tax year 2021. Now, similar to last year, the economic impact payments will not be taxable by Massachusetts. They're not taxable by the federal either. This is a refundable credit. Most people received it in the early part of 2021. It was generally $1,400 per person. We also are not required to include it in the calculation for total income for the circuit breaker credit. And we're going to cover that in a later section. Another change that we may see this year will be that the federal earned income tax credit has had an age change related to people who have no dependents. So previously, if you had no dependents, you'd only be eligible for the earned income tax credit if you were aged 25 to 64. So this excluded many of the taxpayers that we served. The change in 2021 is now if you are 19 or older and there's no upper age range. Now, there are some exclusions if you're doing a tax return for a student or a dependent who's living at home. So do check the rules if you're doing one of those type of returns. But if you're doing a return for a senior, they have a small part-time job, no dependents. Previous year, they wouldn't have been eligible for the earned income tax credit, but now in 2021, they will be, or could very well be, depending on the income level. Another significant change for Massachusetts is that the child care expenses needed for employment and the dependents under 12 used to be a deduction. They're now a refundable credit. Similar to last year, the deduction, you can only take one of these two. The refundable credit is very similar in that you can only take one of these two refundable credits. And we'll talk about that in a bit in more detail. So for the Paycheck Protection Program, this was a loan made to small businesses to retain employees. Now, generally, small businesses that have employees are out of scope, but it was possible for a sole proprietor to get one of these loans and have them be forgiven. Last year, there was a question about whether they were taxable for Massachusetts. The forgiveness part was taxable. So we put it out of scope because of the uncertainty and no way to handle the adjustment in TaxSlayer. This year, we've gotten clarification that the loan forgiveness is not taxable either federally or for Massachusetts. And so it would be back in scope. So if the return is in scope otherwise, now again, these are people who have a small business. So if they have employees other than themselves, if they have expenses greater than $35,000, there's a whole bunch of reasons why small businesses will be out of scope. But if they're not out of scope, this PPE loan forgiveness will not push them out of scope. Also, in the same vein, student loan forgiveness, we've determined, the Department of Revenue has told us that it's not taxable either federally or for Massachusetts, and so we can have this in scope. There's no adjustment that is needed. It's very likely that the person won't even have any tax-related paperwork related to this. They're not going to get a 1099-G or some other form. They may note it on their paperwork, and you just can note not taxable federally or for Massachusetts, so it doesn't even need to be reported. Now, so virtual currency. Now, last year on the federal side, they added a question to the intake form. So any individual ownership of virtual currency puts the return out of scope. So they don't even need to trade it. If they own any Bitcoin or any other virtual currency, the return is just simply out of scope. This isn't a common thing for the taxpayers we serve, so I don't expect it to be a huge issue. Now, it is still in scope if the taxpayer happens to own a mutual fund or an ETF that happens to have virtual currency. So you don't need to go and look at this mutual fund and do research to say, oh, might they possibly have virtual currency in it? If they own an ETF or a mutual fund, it would still be in scope if the return would otherwise be in scope. So it's only if they have direct individual ownership. And again, this isn't just simply they trade it. It's do they own any virtual currency, and that would put it out of scope. So some other changes. Similar to last year, now we didn't get this information until fairly late in the game, but similar to last year, up to $10,200 of unemployment income is excludable if total income is less than 200% of the federal poverty level. Now, for a single person, that's going to be roughly $25,000, family of two, it's going to be about 37, 38,000. So you're talking about relatively low numbers. And so we saw many people did not qualify for this exclusion last year. Do know that this is 200% of the federal poverty level is includes their Social Security and other non-taxable income. So this is not taxable income. This is total income. So if they have a non-taxable pension, they have retirement income, that's all going to get added up. And if they have over 200%, they will not be qualified for this $10,200 exclusion. The software will handle this properly, but if you have to explain it to a taxpayer, you want to understand how the calculation gets done. It's not exact, but if you look on the federal return at what their income is, often that will give you a better idea, because again, that includes pensions that might be not taxable in Massachusetts, or their Social Security. Might give you a better idea, just to help them approximate what it is. And then new this year, this is the first year that we may see payments from the paid family and medical leave program. We're expecting it to be reported on a 1099-G. We don't know yet how TSO will handle it. We're assuming you'll just enter the 1099-G and it'll get handled automatically. Now, there is an open question. The Department of Revenue has said they have not gotten guidance from the IRS on whether this is taxable or not. I'm assuming it will be taxable, but we're going to have to wait and see. So stay tuned for more information. I'm going to recommend that people put a tag on these returns so we can go back and look at them, especially if we don't have guidance early in the year. I don't expect it to be a huge number, but if you do see this, you want to be aware that that's what this is. Now, alimony is not a 2020 change, but it was relatively new from 2019, so I just wanted to highlight it and remind people. Now, the software will do the right thing as long as you put in the correct date of the divorce when you enter the alimony, either the alimony that's paid or the alimony that is received by the taxpayer. So regardless of the date, Massachusetts will make it taxable to the recipient, deductible by the payer. Whereas starting in 2019, it is no longer taxable to the recipient or deductible by the payer on the federal return. Again, as long as you enter in the correct date when you enter in the alimony amount, TaxSlayer will handle it properly. Now for 2020, Massachusetts tax rates have been reduced very slightly. So for most categories of income, the rate is going to be 5.0%. That's down from 5.05% from last year. Now for filing status and dependency, it's really the same for the most part as federal, except Massachusetts doesn't have a qualified widow or widower filing status. If a taxpayer is a qualified widow on the federal, most likely the Massachusetts side, they're going to be head of household. In very unusual cases, someone doesn't qualify for head of household. In that case, there's a box that you would check on the basic screen that says on Massachusetts, even though they're filing qualified widower or widow on the federal side, you need to have them file as single on Massachusetts. Now, personal exemptions for the year haven't changed, so these are the same numbers as they've been for a number of years. And as you enter in the correct date of their birth date, TaxSlayer will enter these correctly. Do make sure that you mark whether the taxpayer is blind, because they will get an additional $2,200. And again, they'll do that by the boxes when you enter that on the federal side. Now, what's taxable for Massachusetts income? Well, all worldwide income while a Massachusetts resident is going to be taxable unless Massachusetts specifically says it's not. So there's a number of things that are common that we see that are not taxable in Massachusetts. Things like interest on U.S. obligations, so that's savings bonds and treasury bills. U.S. government pensions, mass state pensions, and mass municipal pensions. Social Security is never taxable for Massachusetts, it may or may not be taxable at the federal level, but Massachusetts will never tax Social Security. And then public assistance. There's some other common, less common types of income that are not taxable, but the general rule is all income is taxable unless Massachusetts specifically says it's not. And Tax-Aide treats that. If you're a Massachusetts resident and there's income of any type, Tax-Aide will assume it's taxable unless you as the preparer tell it it's not. Now, most information entered with the federal is carried automatically to the state returns. We do need to make a few manual adjustments due to differences between the state and the federal tax law. One thing that's really important to remember: no information from prior year state return is carried forward automatically. So if someone had, say, long-term carryover losses from last year, even if we did the return at the same site, the software will not remember that and carry that forward. You're going to have to enter that in yourself. Now, the main menu for Massachusetts looks similar to as it does last year. One difference is that you will say is that the software will do what's called prompts. So based on what you enter on the federal side, it'll try to direct you to screens that are most likely you're going to need or you may want to do entries for in Massachusetts. After you've done all the prompts, or if you choose to say no to the prompts, this is what the main menu will look like. So let's look at the basic information. So for basic information, key things here, it asks name or address changed, and do you want to give to the state election campaign fund. We do this year have a Massachusetts intake form, and that's one of the questions that we'll ask. And if they say yes, you can go ahead and say yes. Otherwise, you can actually leave the screen blank. You don't actually have to explicitly fill in no. If the taxpayer doesn't make a selection, it'll assume the answer is no. Now, there's some additional information under basic information that we may want to fill out. Now, these items are generally pretty uncommon, so it's unlikely you would run into many cases where you would need to be filling things out, but we want you to be aware, and if the situation does require it, you want to be aware and fill out the rest of the basic information that fall into this screen. The first one is, in general, if you file married filing separately, taxpayer would not be eligible for the earned income credit. There's a number of exceptions. The key one is if the taxpayer is a victim of domestic abuse. And so if you run into someone who's in this situation, you're going to want to pull up the manual and just review whether they meet the criteria for an exception to earned income credit not allowed for married filing separately. And if they do, you go ahead and put yes into this first question in this box. That's do you meet their criteria? Now, the next two boxes are also the case of married filing separately, and they're in the case of married filing separately and the spouse lives in the same household, even for one day. Because the rules for health care require you to know what the household income is, and because of married filing separately, generally you don't have any visibility to what the spouse's income, we're going to have to enter that manually. So you're going to enter in the combined federal AGI from both the taxpayer as well as the spouse. You're going to also include the total income as well. So that's the AGI and total income combined for both the taxpayer as well as the taxpayer's spouse. And again, this is just the case of married filing separately and the spouse lives in the same household. So married filing separately and they live apart, you don't need to do this. The last question is, are you a non-custodial parent? So this is the case where you have a dependent because of a divorce decree. You're allowed to take the dependence to claim the dependence of one or more of your children. However, you need to make sure you be able to say yes to this question if you're in that case. Now, the next subjects we're going to cover will be the income subject to tax. So there's a number of sub-menus. The most common ones really are the top three, and we'll go over each of these menus. So exempt pensions and annuities. They talked about at the beginning about all income Massachusetts considers taxable unless it specifically said it's not. Key one is any U.S. federal pension, uh, state pension, Massachusetts state pension, or Massachusetts municipal pension is not taxable to Massachusetts. So you're going to want to enter in any of those pensions or annuities not taxable in Massachusetts as a negative number. Now, if the taxpayer has only a single annuity, you'll see that in the yellow, you'll get a prompt of the amount that they've entered. And so you can just enter that number in as a negative number, again, if it's a tax exempt pension. If they have multiple pensions or marriage filing joint and there's multiple pensions between the two, you're going to have to use the worksheet to keep track of which of the pension or pensions are not taxable in Massachusetts. If there's more than one, you'll have to add them up, and then you'll enter the total as a negative number. You're not going to include out-of-state pensions here. That's actually a deduction, and we're going to talk about that later. So again, these are for federal pensions, Massachusetts state pensions, Massachusetts municipal, cities or towns, pensions in Massachusetts. Okay, the next submenu is Schedule B adjustments. This is another common set of adjustments that we do have to make. Now, typically, if a taxpayer has interest or dividends that are not taxable to Massachusetts, you're going to want to enter that in box 3 and box 4. I've never actually seen a reason to put anything in box 1 and 2 here. I'm assuming they're from something in the past that's no longer needed. So in general, you have savings bonds or treasury bills. Those are not taxable to Massachusetts, and so you want to make sure that you enter them in box 3. You put the amount in box 3. You need a description here in box 4. Now, if the taxpayer does have prior year short-term unused carry-forward losses, and you would find that on the Schedule B from last year, you want to enter that in the last box right here. Now, it's very important that there is a place when you enter the 1099 int on the federal form, there is a box that asks you to write the amount that's not taxable to the state. Unfortunately for us, we're not able to use that feature. So don't enter that amount in the when you enter the 1099 int. The reason being is there's no place to put the description line. So you have to go make that adjustment on this screen here in the Massachusetts. So when you enter it on the 1099 int, even if you know it's not taxable, you're going to just ignore it on the federal side. Don't fill in that box, and then come on the Schedule B on the state return and make sure that you enter it here. Now here's a nice little table that gives us a summary of what we need to do for Massachusetts interest entries. So this would be for a non-Mass bank, it's taxed both U.S. and Massachusetts. Once you enter the 1099 int, there's nothing special you have to do. For mass banks, there is an exclusion we have, and we're going to show you a little later where we're going to enter that. Government bonds, savings bonds are not taxed in Massachusetts, and we have to do the adjustment that I just showed you. For mass municipal bonds, you're going to have to do the same thing for U.S. government bonds. Even though they're not taxed on the federal return, you've entered them as a 1099 int. Massachusetts tax layer is going to want to tax that unless you explicitly say it's not taxable. Now for Schedule D adjustments, here's where you would enter any prior year long-term unused carry-forward losses. And again, you're going to get that from last year's return on the Schedule D. Note, even if the taxpayer is returning, TaxSlayer Online is not going to automatically carry that forward. The only way TaxSlayer will know that they have a carryover loss is by you entering it, and you'll find that on their Schedule D from last year. Now, Massachusetts lottery winnings and other gambling winnings. So Massachusetts allows you to deduct the price of your winning ticket, just the winning ticket or ticket. So they played the lottery 52 weeks and won 2 and lost 50. You can't deduct the 50 that they lost, but you can actually deduct the cost of the 2 winning tickets, and you would enter it in this screen. Now, generally, most of the time, you're going to get a winnings on a W2G. Now, in the case of unusual case where gambling winnings are on a 1099 MISC, you're going to want to enter it on this screen right here. Okay, the next major menu we're going to cover is the additions to income. Now, key here are allocated tips and taxable scholarships. Those are relatively uncommon. And then the next one is interest income from Massachusetts banks. We do see that one quite a bit. And then taxable IRA distributions. Now, for Massachusetts bank interest, so Massachusetts gives an exemption for interest earned at a Massachusetts bank. It's $200 for married filing jointly. It's $100 exemption for all the other filing statuses. Now, any bank that has a physical presence in Massachusetts will qualify. It can't be an online only bank. It's got to have an actual physical location. But it doesn't have to be, the main office doesn't have to be here. I know sometimes people get a 1099 int and the main address is in Rhode Island. Well, that's okay as long as they have branches that are in Massachusetts. Now, it is important to say things like Massachusetts insurance companies, or if I have an interest that I'm getting from Fidelity, even though Fidelity has a presence in Massachusetts, it's not a Massachusetts retail bank, and so those do not qualify. So I get it from John Hancock. I get an insurance policy, gives me some interest. None of those qualify as Massachusetts banks. When you go to enter it in, you're going to enter it in the menu box here, the second one, which says enter interest income included in return received from Massachusetts banks. Again, you'll enter this in as a positive number. In yellow, you'll see a prompt that will tell you the total amount of interest from the federal side. Now, again, if they just have one and it's a Massachusetts bank, you've got the number right there for you. More than likely, they've got multiple 1099 ints. So you're going to have to use the worksheet to keep track of which ones are from a Massachusetts bank and enter in just the total from Massachusetts banks. Now, these are taxable from a Massachusetts bank. You're not going to include, say, a savings bond that is reported from a Massachusetts bank in this box, because that would be tax exempt. Now, contributions to an IRA made while a Massachusetts resident are not taxable by Massachusetts when taken as a distribution. Now, this isn't applicable for contributions from a deferred compensation plan like a 401k that are rolled over. This is just a deductible IRA that the taxpayer made contributions to while they were a Massachusetts resident. Now, why the special handling? Note the 1040 line item below. The federal government provides a tax deduction for contributions to a traditional IRA. Therefore, that money has not been taxed federally until withdrawn through a distribution. However, Massachusetts provides no such deduction. Therefore, the original contributions made to an IRA have already been taxed by Massachusetts, so are not taxable again when withdrawn as a distribution. Let's look at how this works. A taxpayer makes contributions to a traditional IRA, generally over a number of years. Also, depending on how the IRA is invested, there are gains, either capital gains, interest, dividends, or a combination of all three. Remember, Massachusetts has already taxed the contributions, the money in green, but has never taxed the gains, the money in red. Now, the taxpayer starts taking distributions. They are not taxable until all of the original contributions have been withdrawn. Only when the taxpayer has started to withdraw gains are those taxable to Massachusetts. Now, the taxpayer is responsible for providing the total contributions and the total prior year distributions. If there are no accurate records, then have the taxpayer arrive at a reasonable and defensible figure. Please include that in the taxpayer's paperwork for use in subsequent years. Okay, so now when we're in the taxable IRA, KEO, and Roth IRA worksheet, there's 4 boxes that we can fill out here. Now, if this were a married filing jointly return, we would actually have 4 boxes for the taxpayer and 4 for the spouse. That's actually new in 2020. In previous years, there was only one set of boxes, and it could actually be problematic in certain cases. The first box, generally, we're going to use anytime there's a difference between the state and the federal amount. The common way that this would happen is if someone had an IRA that they had made non-deductible contributions to. For us, with the taxpayers that we serve, that tends to be pretty unusual. But if it does happen, or if for any reason there's a difference between the taxable amount for state and federal, you would make the adjustment in this first box. The second and the third boxes are the common ones that we would use. The second box is the one we fill out for the total contributions taxed previously. So these are the contributions that the taxpayer has made while a resident of Massachusetts. And then the third box is the contributions that they've received previously. So if they've receive distributions of part of that money, we've got to keep track of it so we know when we've exhausted all of the contributions that have been previously taxed. The last box is actually fairly unusual as well, and that is the taxpayer is allowed to take a distribution from their IRA and make a charitable contribution to it. There's a set of forms that they would use, and in that case, you would enter that in that last box. But as I said, with the taxpayers we serve, tends to be fairly unusual. All right, next up, we're going to cover deductions. Now, some deductions are taken automatically based on information imported from the federal. Others will require a manual entry that we have to do ourselves when we enter the tax return, state tax return section of Tax-Aide. So on the mandatory retirement contributions, Massachusetts gives you a deduction for Social Security and Medicare, but those are taken automatically. So when you fill out the W-2, some of the entries you fill out will be what has been deducted for Social Security and Medicare. So Tax-Aide will calculate that automatically. What Tax-Aide does not do automatically is if you have a mandatory state or municipal retirement contributions, and generally you're going to find that in box 14 of the W-2 of a state or municipal worker. Tax-Aide will not take that automatically. You're going to have to manually make that entry. We'll show you on the next screen where you're going to do that. It is capped at $2,000 per taxpayer. And again, that's very important that you make the entries for what you find in box 14. You might find it as something called retirement. There's no standard way of writing it. So you may have to just ask the taxpayer if you see items in box 14 what they are. It has to be a mandatory contribution. If it's something voluntary, so they voluntarily contributed to a retirement plan, that is not going to qualify. It's got to be that it's mandatory. And again, the key is you're going to find this from the state and municipal workers in Massachusetts. So here's where the screen is going to look like. So you're going to say enter amount to adjust retirement deductions. Social Security, Medicare will already be pulled in. So if you have W-2 deductions from Social Security and Medicare, those are going to be covered automatically. You're just adding in the mandatory retirement from, say, box 14 of a W-2. It is really important that you allocate it properly, whether it's the taxpayer or the spouse. So this is one of those taxpayer and spouse each gets a maximum of $2,000 of a deduction. And so if one has 3,000 and one has 1,000, they don't get to share the 4,000. It's not like the Mass Bank interest where together they have a certain amount. This is each is capped at 2,000 total. So it's important that you identify it specifically, whether it's the taxpayer or the spouse has the additional box 14 retirement amount. All right, other deductions, student loan interest. This is for undergraduate studies only, and you want to only enter the part that was over the federal limit or that was disallowed for some other reason. Okay. Certain gambling losses. So this is another deduction that Massachusetts does allow. However, it's only valid for Massachusetts casinos. So that would be Plainridge, MGM in Springfield, and the Encore Boston Harbor. Now this deduction is limited to winnings at the Massachusetts casino. So you can't offset it with, if the taxpayer had winnings at Las Vegas or Atlantic City or other places like that. They can't offset it from winnings at other casinos. It's just offset by Massachusetts winnings. Other deductions, prepaid tuition or college savings plan. So these are programs that are established by the Commonwealth of Massachusetts. They are capped at $1,000 for single, $2,000 for married filing jointly. Commuter deduction. This is for either an Easy Pass or MBTA pass. Deduction for amount over $150 capped at $750 per person. So for each taxpayer and or spouse. So again, can't share it. It's got to be for each person. And again, the first 150 is not deductible, but you can go from 150 to 750. Out of state pensions. So here's another deduction. We talked earlier how government pensions, so either U.S., Massachusetts state, or a city or town in Massachusetts municipal pension is not taxable. And we already showed you how to make that adjustment. Out of state pensions are treated differently. These are treated as a deduction. You have to go into the Mass manual, and there's an appendix that you'll look up the state and will tell you how Massachusetts handles that. Some are fully taxable, some are partially, some are not taxable at all. And so no way to memorize this. You run into this, you're just going to go look it up on a per state basis. If it's not fully taxable, then you're going to enter the amount that's not taxable in this form. So the deductible amount of a qualified contributory pension from another state or political subdivision included in income. Okay, the default will be that it will be fully taxed to Massachusetts. So if it's fully taxed, you do not need to make any adjustment. It's only if it is partially or not at all taxed that you are going to go enter this. Again, this is out of the deductions menu, unlike what we did previously with the U.S. or Massachusetts state or municipal pensions. All right, let's look at some other deductions. Okay, so now there are some other deductions that are possible here. So we have the college tuition deduction, allowable business expense, and rental deduction. And you see you don't even need to go into the sub-menu. You can just enter it directly on this screen. It's probably the most common of these deductions that we would have. Rental deduction. Now, Massachusetts does allow a deduction for 50% of the rent paid for the principal residence in Massachusetts. It's capped at $3,000 for most filing statuses, except it's only $1,500 if you're married filing separately. Now, it is allowed even if you're taking the circuit breaker credit. We're going to cover that in the credit section. We usually say no double dipping, but in this case, if the taxpayer is allowed to take the rental deduction and they're allowed to take the circuit breaker, they can take both the rental deduction and the circuit breaker credit. Now, this is very easy to miss. Remember to ask all taxpayers if they pay rent, and if they do, you enter this in and they get the rental deduction. Doesn't matter if they have subsidized housing, doesn't matter if they live with a roommate, whatever they are paying for rent out of pocket, they can take as enter it in as a rental deduction. The software will calculate 50%, and the correct cap is $3,000 or $1,500, and take it as a deduction on the tax return. Now, Massachusetts does provide a deduction for college tuition. However, it's more restrictive than what we find on the federal side. It's for undergraduate degree programs only, so it's not valid for any graduate school tuition. It includes tuition and mandatory fees only, so no room and board or parking, similar to what we see on the federal side, but also no books or required equipment either. It's limited to an amount that exceeds 25% of the AGI of the taxpayer. So, say in the case of a taxpayer who has an AGI of $40,000, they will only be able to deduct the tuition that's greater than $10,000 or a quarter of their AGI. So we're going to find very few of our taxpayers will be eligible for it. But if you do find the case of someone who is paying significant tuition and has low AGI, they may be able to benefit from this deduction. Now, Tax-Aide Online does not carry this deduction automatically from federal, probably because the amount we put in when we enter either the American Opportunity Credit or the Lifetime Learning Credit, the rules for what expenses count are different. So you have to manually add this when you do the Massachusetts adjustments. Now, if you pull up the deduction menu under the college tuition deduction, you're going to enter in the total tuition payments. This is generally what you're going to find in box 1 of the 1098T. And then in box 5, you're going to find the scholarship grant financial aid. This will be deducted from the box 1 total, and that'll be how Tax-Aide arrives at what the taxpayer paid for tuition. Again, there's no place to enter books or expenses because they're not deductible in Massachusetts. All right, let's look at credits. Okay, we have our non-refundable credits. Now remember, from the federal side, non-refundable credits can reduce our tax liability down to potentially zero, but can't go below zero. Refundable credits can reduce your tax liability even below zero, meaning you would actually get money back. So for non-refundable credits, we've got under our scheduled CMS credit management system, we've got the septic credit, and that's scheduled SC. It's a maximum of $1,500 annually for meeting the Title V requirements over a period of 4 years. So that would be $6,000 maximum. There's also the lead paint credit, that's Schedule LP, the maximum of $1,500 for lead paint removal costs. Okay, let's look at some refundable credits that we have here in Massachusetts. We're going to cover the earned income credit, the children under 13 or disabled dependent spouse care expenses or daycare expenses, or expenses necessary to work, and then dependents under 12 or 65 or older or disabled. And then finally, the circuit breaker credit. We see a lot of circuit breaker credits for the population that we serve, so we want to make sure people are comfortable doing that credit for people. Okay, the earned income tax credit. Now this is earned income below a certain threshold, and the threshold increases as the number of dependents and people in the household increase. So you have to look up the amount each year. In Massachusetts is 30% of the federal earned income tax credit. And the good thing here is Tax-Aide Online will calculate it automatically. So you don't have to do it, any calculations or adjustments yourself, but just be aware if you see EITC on the federal side, you're going to see the Massachusetts earned income credit as well. Note that previously, to qualify with zero dependents, people had to be between ages 25 and 64. That precluded many of the taxpayers that we serve from qualifying for this credit. Starting in 2021, this age has been changed to 19 plus. There's some exclusions for students and for dependents, but generally, if you run into a taxpayer who's 70 years old, has a small part-time job, in the past, have no dependents, in the past they would not have qualified for this credit. In 2021 and forward, they will qualify. So children under 13 or disabled dependent or spouse care expenses. So this is formerly had been a deduction. In 2021 going forward, these are refundable credits. So these are for employment related care expenses. So they have to be incurred before the child turns 13. Again, that's assuming it's not a disabled dependent or spouse. For a not disabled dependent or spouse, the child has to be younger than 13. Unlike other age requirements where they care about the age as of December 31st of the tax year. For this, if say a child turns 13 in December 29th, well, the taxpayer is entitled to take the expenses incurred up to that December 29th date. So even though they turn 13 during the year, you can use the employment related daycare expenses up till their 13th birthday to be eligible for this credit. Now the credit is a maximum of $240 for one person eligible and 480 for two or more. It's not allowed if you're married filing separately on the federal. If a taxpayer files jointly on the federal and they do married filing separately on Massachusetts, then it is allowed. The spouses can split the credit as long as between the two of them they don't take more than the maximum. So people can do up to whatever their expenses were. Again, up to a maximum of 240 for one, 480 for two or more. And again, if the spouses split it, then they can only take the expenses that they incurred. And again, as long as both of theirs stays under the 240 or the 480. Now for dependents under 12 or 65 or older or disabled, this is going to be the age of the last day of the tax year. So if a child turns 12 during the tax year, they're no longer going to be eligible for this credit. Now the credit is $180 for one, $360 for two or more. It is not allowed for the taxpayer or the spouse. It's not allowed if married filing separately. And similar to how the deduction was in the past, if you're taking the previous credit for daycare expenses needed for employment, you can't take this one. So generally we're going to put in for both, figure out which one's better, and then have the taxpayer take advantage of whichever one's greater. TSO will automatically calculate this credit, unlike the daycare ones where you have to manually add in the amounts because they have to calculate how much you paid per child. This one, TSO will automatically calculate it. Now you'll see the credits menu in TaxLayer. The second from the bottom is the Senior Circuit Breaker Schedule CB, and it's the most common credit that we do for our taxpayers. In my site, we do maybe 30% of all taxpayers that come in are entitled to get this circuit breaker credit. So it's fairly common. Okay, the senior circuit breaker credit is on Massachusetts Form 1 Schedule CB. So the maximum you see for the current year, and it goes up generally $20, $30 every year, so it'll go up over time. The taxpayer or spouse must be at least age 65. They don't both have to be 65 or older, just one of them. And you qualify by if the real estate tax that they pay plus 50% of the water and sewer exceeds 10% of total income. Now we're going to talk a little bit about what total income is in a little bit. Now the credit will be the difference between what they're paying for real estate tax plus 50% of the water sewer and their total income up to the maximum allowed for that tax year. Now for renters, if 25% of the rent exceeds the 10% of the total income, the taxpayer will qualify. However, the taxpayer must not be having subsidized rent. So they can't live in public housing, they can't be getting rent subsidies, vouchers, any kind of assistance. Now we say that for the home ownership rules that the person owns the home that they live in, their principal residence. However, sometimes we run into cases where the home is in a trust. So there are different rules depending on the type and the conditions of the trust. In the case of a grantor or a revocable trust and the taxpayer is a trustee, then you're going to just use the homeowner rules. Basically, it's a revocable trust. The taxpayer has total control over the property in the trust. They at any time could take the property out of the trust. So in effect, there's no difference between them being the true homeowner. They really are the homeowner, and the Department of Revenue treats it as such. Now, in the case of a grantor or revocable trust where the taxpayer is not the trustee, or in the case of an irrevocable trust, you have to use the renter rules. And why is that? Well, the the person doesn't actually own the home, so they're not a homeowner. They don't own the home that they're using as their principal residence. Now, in the past, we've used, well, whatever they paid for taxes, we've used that as the quote rent. The Department of Revenue has given us guidance that says only if the trust documents specify that in order to live in the house, the person needs to pay quote rent to the trust is that allowed and to be able to use the renter rules. So Department of Revenue doesn't consider just paying maintenance or paying real estate taxes as by default rent unless the trust documents specifically say that. Now, we're not expecting any of you to have to go examine trust documents. So you're going to explain to the taxpayer the rules. And if they assure you that it's a requirement in the trust that they pay rent and this is the rental amount, then you want to just advise them that the Department of Revenue follows up with them. They're going to want to see the trust documents to confirm that it is actually rent. Okay, for taxes, water, and sewer, let's look at what we can include and not include for our expenses. We can include real estate taxes. Now, these are ones actually paid by the taxpayer during the calendar year. We can include the CPA surcharge that is included on a number of bills that different towns, cities and towns assess. Incidentally, you can also include the Cape Cod Open Land Acquisition Program surcharges. Can include water and sewer charges. In the past, we've only allowed municipal water and sewer bills. Our state leadership has gotten additional guidance from the Department of Revenue, and we can include water and sewer from a private company as long as it's for water and sewer usage. We cannot include maintenance or private well costs or pumping out a septic system, those kind of costs. But we can include water and sewer usage bills from a private company. Now, things we cannot include, if the taxpayer has gotten some late fees or penalties or surcharges, not able to include those. Can't include any demand fees or interest. A number of towns include their trash on their bills. You have to subtract that out. You can't include the trash. And again, you can't include water or sewer maintenance costs. Okay, for the current year, the income levels have gone up slightly. They generally go up 1 or 2,000 every year. You can read the limits for each of the filing statuses. Notice that if a person is married filing separately, they are not eligible. It won't even show up on the TaxSlayer Online menu, on the credits menu. You won't even see the ability to click on the circuit breaker submenu item. And then you see the amount for the maximum assessed property value. You're going to enter in the property value, and if it's over the limit for the tax year, again, the taxpayer will not be allowed to take this credit. Now, the acreage of the principal residence is limited to the property taxes for the home plus a maximum of 1 acre of land. If there's greater than 1 acre, then the land tax must be apportioned. It must be prorated. There's a calculator on the Tax-Aide.org website under tools that you can use to prorate the taxes. You also have to prorate if it's a multi-unit dwelling or multiple lots. So sometimes you'll see a taxpayer come in with their lot and with the house on it, and then an adjoining lot that maybe is not developed. You could only use the taxes on the lot with the principal residence on it. You can't use the total real estate taxes for both lots. Now, if they're itemizing on the federal side, they can certainly deduct the property taxes for both units, but for the purposes of the circuit breaker, you can only do the lot on which their primary residence is. Okay, so the first entry screen on the Schedule CB, you're going to enter living quarter status during the year. So it's either going to be homeowner or renter. And then if the taxpayer is the homeowner, is it a multi-use or multi-family property? So you're going to say yes or no. Generally, the answer is going to be no, but if it is, you want to put yes. Now, there is a worksheet for the address of the principal residence in Massachusetts. Now, as long as the mailing address on the return is the same as the principal residence, there's no need to enter into this worksheet. If, on the other hand, the taxpayer, say for instance, is using a post office box for a mailing address, then you have to actually enter in the principal residence, the address of the principal residence. It's not going to be used for mailing, but it's going to be provided as the address of the principal residence to qualify for the circuit breaker. Okay, in the case of a homeowner, you're going to need to enter in some information. You're going to enter the assessed value of the principal resident as of January 1st of the tax year. You'll enter the real estate taxes paid during the tax year for the principal residence. It doesn't matter if the taxes were for a previous tax year, and in fact most cities and towns have a tax year that goes July 1st to June 30th of the next year. So you're often paying Q3 and Q4 and then Q1 and Q2 of the next year. So again, you're looking for tax bills that were paid during the calendar year of the tax year. And then you're going to add 50% of the water and sewer use paid again during the tax year. You do have to prorate if the real estate taxes were on a property that's more than 1 acre. In the case of a renter, you're going to put the total amount of rent paid. You also need to include the landlord's name and address. They're very important. The circuit breaker credit cannot be taken if subsidized housing at all. And that means if there's any federal, state, or municipal subsidy, not entitled to take this credit. If they are entitled for it, then you can take both the rental deduction and the CB credit. Most of the time we say no double dipping, but this is one example where if they're allowed and they qualify to take the rental deduction and the CB credit, they can take both. Okay, we now want to look at adding in any qualifying income. Now, Massachusetts doesn't tax the taxpayer on these additional qualifying income, but it does go into the calculation for circuit breaker. Remember, we're using total income, not taxable income for the calculations. So under miscellaneous income, we're looking for if the taxpayer is receiving any cash public assistance, things like SNAP, food stamps, fuel assistance, those sort of things. Also, are they receiving any regular income, even as gifts for their support? Now, we're not talking about one-time gifts like a birthday gift, but regular support income that they're receiving from a private party. Now, for this last box, we want to add in any additional amounts from pensions and annuities not taxed in Massachusetts. Now, if the taxpayer has an exempt pension from a state or municipal pension, then TaxSlayer will automatically include that in. We don't have to add that here. But if they have something like a Roth IRA, a distribution that hasn't been taxed by Massachusetts, we're going to have to add that here. We also have to add the difference between the gross and taxable amounts for any pensions or annuities that they're receiving. So say, for example, the taxpayer were receiving a $20,000 pension, but the taxable income from it is $18,000. We would want to include $2,000 here as additional income. Now, Massachusetts is not going to tax the taxpayer on it, but it does go into the calculation for total income. So something to note for the current year for 2020, taxpayer probably received the economic impact payment, the stimulus payment, one or two payments during the year. So we don't include this in gross income. It's not taxable income. We also do not need to include it in the total income received. So there's no need to add in the economic income payment to the taxpayer's total income received for the year. It's treated as a refundable tax credit, which is not included in total income. All right, then we're going to cover Massachusetts healthcare information, what's called Schedule HC for healthcare. Okay, for healthcare, Massachusetts healthcare, the taxpayer and spouse, if filing married, filing jointly, if they're age 18 or older, they're expected to purchase health insurance if it's affordable. Dependents of any age are not required to have coverage. Now, obviously, it's a good idea, but there's no penalty for dependents not to have coverage. Now, penalties do apply monthly for any month that there is non-compliance, that the person doesn't have coverage. Now, in the past, there was a shared responsibility penalty on the federal side. So the Massachusetts penalty would be zero if the federal penalty was greater. Starting in 2019, that shared responsibility penalty on the federal side has gone to zero. And so we will now see people without health insurance will be assessed, may be assessed a Massachusetts penalty. Now, insurance must meet state minimum credible coverage standards. You'll see that written in various healthcare forms as MCC. Now, Form 1 Schedule HC must be completed for a taxpayer and the spouse if filing married, filing jointly. On it, it has the insurance provider, the provider number, subscriber number for in the case of private insurance. And you get that information from Massachusetts Form 1099 HC. And that's a specific to Massachusetts healthcare form. Now, Medicare, VA, military, or other government insurance coverage for any period of time is equivalent to full year coverage. So if we have a taxpayer come in and they have any of those, you can just select full year, even if they had coverage just for one day. This is not applicable for Mass Health. So let's talk a little bit about Mass Form 1099 HC. So in the case of private insurance, or if someone has Mass Health and their income is above 150% of the federal poverty level, they should be getting a Form 1099 HC. Now, for people with Medicare, military, other government insurance, or for Mass Health taxpayers whose income is 150% of the federal poverty level or below, they're not going to be getting a 1099 HC, and they don't need it. So that's why they don't get it. Now, when you go into the tax layer menu, the first box, first entry for Massachusetts specific is Massachusetts Healthcare Schedule HC. There are 5 submenus. A typical case for a taxpayer or a taxpayer and spouse that has full year MCC, we really need to only enter information in the first 2 boxes, the basic questions and the health insurance plan information. If they have partial year coverage, you're going to need to fill out the months covered. If they have an exemption, common one is a religious exemption, or there's a question about whether coverage is affordable. you would fill out the remaining three boxes. So basic questions. First question is asking you're 18 years or older and a resident. You're going to answer typically yes, unless it's a student or someone that comes in that's 16 or 17 years old. They're not required to have health insurance. Answer the question no. Answer whether they have full year or part year, but there's no need to proceed because they're not going to be subject to any kind of penalty anyhow. So taxpayer, if it's a married filing jointly, you're going to see boxes for both taxpayer and spouse. Your choices here for these drop downs are full year MCC, part year MCC, or no coverage at all. So you're going to pick one of those three. Okay, for health insurance plan information, you've got a set of boxes. There's actually 5. I only put 4 up on the screen because the 5th is very, very uncommon. But of these, really 3 are pretty common that we will see. The first pair of boxes is if the taxpayer has Mass Health or Medicaid, and you're going to answer yes here if the taxpayer and or the spouse has that. The second pair of boxes, most common for people volunteering at the senior center, is that people have Medicare. So the majority of our taxpayers have Medicare, so you're going to answer yes to this set of boxes. If they do have VA coverage, we do see some of that. That's going to be the next set of boxes. And then the fourth set, if they have private insurance. Now, private insurance includes employer provided or if they purchase it directly from the Mass Health Connector. So you're going to enter yes here. One thing that's very important to note, if the taxpayer has both Medicare and a private supplement insurance policy, you want to just select Medicare. You don't want to say yes to the private insurance too, and you don't want to add in the private insurance information on the next screen. So if they have both Medicare and a private insurance policy, just say yes to the Medicare, and then you're done with this section. So if they do have private insurance, you're going to have to complete this section. If it's very important that we see if a taxpayer has Medicare and then has a private insurance company as a supplement, don't enter this information. Just select Medicare on the previous screen and you're done. If they have only private insurance, then that's where you're going to be filling this out. So that's the fourth pair of boxes on the previous screen. So here's you're going to get the information from the 1099 HC that the taxpayer should have provided you, the name of the insurance company, federal ID number from the 1099 HC, and their subscriber number. If they happen to have more than one 1099 HC, say they had coverage from employer part of the year, then maybe direct from a different part, you're going to have to enter in as many as they provide. Again, typically you have one, but occasionally you'll see a taxpayer come in with 2 or potentially even more, but generally at most you're going to see 1 or 2. All right, so some additional special circumstances we want to cover. So if the taxpayer or the spouse is turning 18 during the year, the mandate to have health insurance applies starting on the first day of the 3rd month after their birth date. So if they turn 18 in March, that would be April, May, June. June 1st would be when they would be required to start having health insurance. This is not applicable for a dependent turning 18 during the year because, again, there's no requirement for dependents to be having health insurance. It's just if the taxpayer or the spouse. Part year resident, it's similar. First day of the 3rd month after they become a resident. If they're leaving, it's going to be the last day of the last full month of residency. So they move out July 20th. They need to have had coverage up till June 30th. In the case of deceased taxpayer, it's similar up to the last day of the previous month before they passed away. For the question you're asking about part year or full year MCC, if a taxpayer is in one of these special circumstances and had coverage for all of the months that they were required to have coverage, then you should answer the question full year MCC, even though they only had coverage for part of the year. So if someone turns 18 and they're required to have coverage starting June 1st, they have coverage from June 1st through the end of the year, you should just list full year MCC because they had coverage the full year they were required to have it. Okay, so for Schedule HC, in the case of part year MCC or no MCC, the good news here is the vast majority of our taxpayers have full year coverage. So we're going to enter the basic questions and the health insurance plan info. Those are the top two sub-menus, and then we're done. In the cases of part year MCC or no MCC, we're going to need to fill out some additional sections. Okay, now let's look at the three sub-menu screens that we have to cover in the case where there's not full year MCC, either no coverage or partial coverage. You see the months covered screen is, I don't have a screenshot in for it, but it's pretty self-explanatory. You're just going to indicate which months that the taxpayer had coverage. If it's a married filing jointly return, you'll have to fill in for both the taxpayer and the spouse which months they had coverage and which they didn't. For exemption questions, there's a number of questions, whether they have a religious exemption or have an exemption from the marketplace. And then finally, the last one is the affordability questions. So in the case of not full year MCC, there's no penalty if they have Medicare, VA, or other government insurance, if they have a gap of 3 consecutive months or shorter, or their income is less than or equal to 150% of the FPL. Other exemptions, sincerely held religious beliefs that cause you to object, or they have some certificate that exempts them from the Mass Health Connector. TaxSlayer will correctly exempt for these, so you just need to mark it in the appropriate boxes in TaxSlayer, and TaxSlayer will exempt the penalty. Appealing penalties. Taxpayer can appeal the penalties for hardship reasons, so homelessness, eviction, significant unexpected expenses due to a variety of hardship reasons. So check the Schedule HC instructions for a complete list. And if you do run into someone, it's worth it to spend a couple minutes to just run through the list with them and see if there's some reason that you can use to exempt them from the penalty. We don't have to provide any of the information, so you're going to go through this with them, and if they have a reason to appeal, you mark that box on TaxSlayer, and within 30 days they'll get information that they'll get a request for additional information and have to substantiate it depending on what the reason for it is. Other advantage of the appealing the penalty is that it delays having to pay it. So even if their appeal is denied, they can pay the penalty later on in the year. So here are the exemption questions. So the religious exemptions, such as certificate, and then if you wish to appeal the penalty. It is important that if you don't mark yes to the appealing the penalty, then the taxpayer loses the right to do so in the future. All right, so for affordability, there are 3 tests for affordability. All 3 have to be not affordable in order to qualify for an exemption from the penalty. If any one of them are deemed affordable, then a penalty will be assessed. Unfortunately, TaxSlayer will not automatically calculate these tests. You either have to do it by hand, or there's a calculator that you can use that will help you answer these affordability questions. So here's what TaxSlayer looks like. So it basically asks the 3 questions, but they're just asking for yes and no. There's no guidance or worksheets in TaxSlayer itself that's going to help you come up with the right answer. And so you're going to have to do that, again, either manually by hand using the instructions or using the calculator. All right, so let's look at the first of the 3 affordability tests. So the employer offer of health insurance. Now, if the employer doesn't offer health insurance that covers the taxpayer and spouse if married filing jointly and all dependents, then you're just going to answer no, it's not affordable, and you're done. If they do offer it, you're going to look for what the cost of the insurance would be. Generally, on a larger company, you would get a Form 1095-C. If it's a smaller company, you may have to ask HR or the owner or manager or benefits, whoever handles the benefits in your company, what would the cost be of insurance to cover for your whole family. Look up the affordability percentage in table 3 in the Schedule HC directions. There's you're going to look at what the family size is, whether it's family size of 1, that's a single or married filing separately with no dependents. 2, family size of 2, which is either married filing jointly or head of household with 1 dependent, or 3 or more. You're going to multiply the AGI by the affordability percentage, and if it's less than the yearly cost of insurance, then it's not affordable. So here's what the affordability table looks like and you'll find this in the Mass Schedule SC instructions. You'll see that there's a range. This is actually the individual and married filing separately, so basically family size of 1. There's 2 more of these tables. I just cut and paste the top part of it. So there's a second part of it which has married filing jointly with no dependents, or head of household with 1 dependent, and then there's the family size of 3 or more. You'll see for each of the income ranges, it gives you a percentage. It says if you can find insurance with say someone's $20,000, that's going to be that second row. If insurance is less than 2.9% of the AGI, then it would be affordable. And again, as the higher adjusted gross income, the higher the percentage. Okay, now the second test is whether the taxpayer is eligible for subsidized insurance. Now, generally, if a taxpayer's AGI is less than or equal to 300% of the FPL, then they'd be eligible for subsidized insurance. That means if they're eligible subsidized insurance and didn't get it, then they are going to be liable for a penalty because insurance would have been affordable. There are some exceptions. So if the taxpayer is not in the U.S. legally, if they got an employer offer of individual insurance that was less than 9.86 of AGI, that number tracks the Affordable Care Act federal number, or if they applied and were denied Mass Health Connector care or subsidized insurance from the Mass Health Connector. You might see this in the case where someone applies to on the Mass Health Connector, they estimate their income for the year higher than what it turns out to be. So they think they're going to be greater than 300%. So they're not eligible, but they turn out to not make as much as they expected, and they are then under 300% of the FPL. Now, do note that the answer may be different for the taxpayer and the spouse. For the first test and the third test, if you have a married filing jointly, both taxpayer and spouse are going to have the same answers. In the case of this test, it is possible to have different answers, particularly if one of them gets an employer offer of individual insurance and the other one doesn't. Now, to look at the third test, insurance from the Mass Health Connector, we're going to look up the affordability percentage on table 3. Again, that's going to be the family size of 1, 2, or 3 or more. We're going to look up the monthly cost of insurance in table 4. Now, this table is divided into a number of criteria. It's divided by regions, and different counties within Massachusetts are in one of the 3 regions, and it's by the age of the older spouse. Now, you are going to use the age as of January 1st of the tax year For most things in the tax system, we look at the age at the end of the year. But since when you're buying insurance for a particular year, you're buying it at the beginning of the year for that year, you're going to use the age as of January 1st. You're going to also look it up by individual, by couple, or family. And that's how we generally would purchase insurance. You're going to multiply the AGI by the affordability percentage, and if it's less than the yearly cost of insurance, then it's not affordable. So here's what table 4 looks like. And again, I've truncated it to show the first part with region 1. There's another part of this that says region 2 and region 3. You see that again, it's grouped by age and whether they need an individual, a couple, or a family policy. Okay, so if a penalty does apply, TaxSlayer is going to automatically calculate it for you. If they have no coverage, then they're going to pay a penalty for all 12 months. If they do have gaps, then penalties for months after the first 3 for each gap. So take a case of a taxpayer has coverage gaps March to June and September to December. Each of those are 4-month gaps. So March to June, there's no penalty for March, April, May. They will pay a penalty for June. Same thing, September, October, November, no penalty. They will pay a penalty for December. So the penalty is only 2 months. It's a pretty good incentive to at least have part year coverage because again, every time you have a gap, the first 3 months are exempt from a penalty. Once you know how many months, you're going to look up the penalty per month. And again, TaxSlayer figures this out for you. But if you're having to explain to a taxpayer why they're getting a penalty and how many months they're paying a penalty for, it's good to know where the how TaxSlayer is calculating it. Okay, here we have the penalty tables 5 and 6. Now, TaxSlayer will calculate these penalties automatically, but if you have to explain it to a taxpayer, you want to be able to understand where the numbers come from. So depending on what the family size is and what the AGI range is, you'll see that the taxpayer is either in column A, B, C, or D. And then depending on which column there is, if you see table 6, you'll see the monthly penalty amount per month, depending on what column they're in. All right, let's look at some additional tax information. So we have use tax, and this is going to be owed for purchases out of state. Also is included untaxed internet or online purchases. Might be prudent for taxpayers living near border states with low or no sales tax, like for example New Hampshire. You can either calculate it from all receipts, or you can use what's called the safe harbor amount. So in the case of use tax, if we're going to use the safe harbor amount, you can just say you want to report a safe harbor amount. You say yes. You want to identify if there are any purchases of $1,000 or more in addition. And then if you paid taxes to another state or jurisdiction for sales or use tax, you will get credit for it as well. So this may be prudent for taxpayers living near low or no tax state, or if they're making untaxed internet online purchases. Let's look at payments. Now, withholdings are automatically pulled from W-2s and 1099s. There is an option to apply a refund to next year's tax return, and there's an option if taxpayer applied last year's refund to this year. Very important to know that on the federal side, if the taxpayer returns, so they came in from to the same center from previous year, and they applied their refund last year to this year, TaxSlayer will carry that over. That does not work on the state side. If the taxpayer applied their state refund to this year's state taxes, that does not automatically get carried forward. You have to notice it, and usually the taxpayer will remember it, or often they'll remember it and they'll remind you. And so make sure that you note whether they applied last year's refund to this year, and you're going to have to enter it directly. I would recommend if they do this for next year, so they apply this year's refund to next year, mark it on the folder on the white envelope quite clearly, so make it easier for the tax preparer next year to note that, or you can add a note in their record so that the counselor next year realizes it in case the taxpayer forgets to tell. Now let's look at one of the new items for 2019. Massachusetts has a new thing that has started called Massachusetts Paid Family and Medical Leave. Now all W-2 employees are covered. You're going to see the amount that has been withheld for this, coded as MAPFML, will be in box 14 of the taxpayer's W-2. 1099 miscellaneous contractors may be covered. There's rules that the employer has to follow, and whether a contractor is or is not depends on their use of contractors. If a 1099 miss has withholdings for it, it will be coded in the same MAPFML. It'll be box 16 of the 1099 miss. Now, self-employed taxpayers may opt in. If they do choose to opt in, they're going to have to provide you the amount of the contribution. Now, for most taxpayers, the paid family medical leave withholding is handled automatically. There is a possibility, though, because it is capped at a certain income level, that if a taxpayer has more than one W-2 or 1099 miss, it's possible that they could have withheld excess mass PFML. If the taxpayer just has a single W-2 or 1099 miss, then there's really no way to have excess MAPFML. If they do have multiple, or if they have one or more W-2s or 1099 miss and they were self-employed and opted in, it is possible that they withheld excess MAPFML, and we're going to have to fill out a worksheet so that they can get a refund back for that excess withholding. So if you're in this case, add up the MAPFML from all of the sources. Now you're going to total this separately for the taxpayer and the spouse if married filing jointly. So you're not going to combine withholdings from the taxpayer and the spouse. You're going to add each one up separately. If the total is greater than $502.36, you're going to fill out the worksheet in the Mass DOR Form 1 instructions. Once you've done that worksheet and you have the final answer, you're going to enter that manually in TaxSlayer. You're going to go to the Payments menu, and then there's a box labeled Excess Paid Family Leave Withholdings, and that'll get refunded back to the taxpayer. It's as if it's a payment, and it'll be refunded back to them. The key takeaway here for you is if the taxpayer has only a single W-2 or 1099 MISC, or if their withholdings are under $500, there's no problem here. You don't have to do anything. There's no work for you. It's only if you're finding that the total is over 500 and they have multiple W-2s or 1099 MISC that you may have to look a little further at this. And again, the amount will be refunded directly to them. So if they are entitled to this excess contribution number, we do want to fill it out, but it should be extremely rare with taxpayers that we generally see. So let's look at some resources that are available to us. Many resources are available on the Mass Tax-Aide website. There are links to the IRS and Department of Revenue forms and instructions. Mass Manual, invaluable to be able to do tax returns for Massachusetts. This is the key document you want to be able to reference. There's the Scope Manual for Massachusetts returns to make sure that you're correctly identifying what things are in scope and not in scope specifically for Massachusetts. There's the workbook, which is a set of practice problems, and a link to tools and calculators that you can use. Highly recommend to sign up for the blog updates. So then that way, when there are updates to the blogs, notices, you'll get that automatically by email. So here's what the Mass Tax-Aide website looks like. You'll see that there are a number of tabs with training, reference materials. There's a section for volunteers only. You're going to find these videos under the volunteer section, as well as the workbook. All right, Massachusetts worksheet. There is a worksheet available on the masstaxaide.org website. In our district, we do use one that's a little bit more detailed. Doesn't really matter which you use, but it's probably a good idea to pick one within a given site. So then that way, the counselors and the people doing the quality review are all familiar with and are using the same one. You want to use one of these worksheets to keep track of the Massachusetts differences as you're doing the data entry, as you're doing the federal return. You're making note of the things that will need an adjustment once you get to the Massachusetts tax return. So you don't have to go through all the source documents again once you get into the Mass state return. Okay, here's an example of the tax layer worksheet. This is the one that's on the masstaxaide.org website. Some sites do use their own version of it, but they basically all capture information that you can make notations on as you're doing the federal return. The goal here of these worksheets is that as you're handling documents, as you're processing documents on the federal side, you make notations of things that will need an adjustment when you're later on doing the Massachusetts part of the return. This helps you avoid having to handle every document twice, once while you're doing federal and then handle them all again on the Massachusetts side. You can download a copy of this from the masstaxaide.org website. We do have a new form this year, a Massachusetts intake form. In the past, typically a preparer would be doing the return with the taxpayer sitting next to them or across the table. So as questions came up while doing the Massachusetts Massachusetts return, you could simply ask the taxpayer. Since sites are either using some sort of scanning model or a low contact in-person model, generally the taxpayer is not going to be sitting there able to answer forms. The intake form we normally have, which we will still use, but basically captures things that are needed at the federal level. But there's often a set of Massachusetts specific questions that we end up asking. Because the taxpayer is not right there to ask them, we're going to want to try to capture them when the taxpayer is doing the intake. So they do the regular intake form, and then we're going to ask them to also do this Massachusetts income intake form. And again, it's going to help capture some of the special questions that we tend to have to ask when we're doing the Massachusetts return. Okay, well that wraps up this training video for Massachusetts tax returns. There is the additional information related to the Schedule HC in the case of part year or no coverage that you may want to also view if you're going to be doing tax returns with taxpayers who don't have full year coverage. Thank you very much. Please feel free to give us any feedback or input on improvements or suggestions of these slides and video. Thank you very much.